This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Andrew Joseph, who is no stranger to our Trigger webzine subscribers and our now 4 times a week technical market alert updates. Andrew is the principal of Golden Phi, publisher of Triggers Media Publications, Inc., and editor of the Triggers webzine and website. Good morning, Andrew. Welcome back to Macro Analytics, and I hope you are having a great summer, and I know technically you have.
Thank you, Gordon. It's great to be back here with you again and going through some of the things that we've been seeing. And yeah, we've had a pretty good summer. We've been working on a few things, a methodology, and trying to develop, and it seems to be paying off right now.
Well, I know the charts you brought with you this morning really show that and show some of the results here from the summer. I've mentioned this in prior sessions, but for those that may have missed, since we have actually a very rapidly growing audience of new listeners, I asked Andrew to join me on Macro Analytics in 2012 for a number of reasons, and let me share those with you. One, he's an excellent market technician, in my mind, clearly going to be one of the major players in the field. That'll come out as he takes you through the charts. 2, he has a solid grasp of not just classical technical analysis, but additionally many of the new emerging areas that are truly less understood by mainstream technicians, and that makes all the difference in the world. And 3, his ability to distill the tremendous amount of content we produce at Gordon T. Long into a very concise and practical format for all types of traders, whether swing traders, position traders, day traders, depending on your time frame. The graphic you see on your screen shows the overall filtering and analysis process we go through at Gordon T. Long, which culminates for traders and serious investors in the Triggers service. Any comments you'd like to make here, Andrew?
Yes, thank you very much first for the praise. The work that I'm doing, I could not be possible at all without the work that you're doing. What goes on in Triggers is distilling that information that you do so well, the information, the 400 or 500 pages that you put out every month, and what it's saying. I try and take that and put it into Triggers so that it's down to 40 or 50 pages and just gives the reader the essence and what's the most important need to know information. And then from there, we take that and try and apply it to the markets for a more trading perspective.
Before we get into the slides, Andrew, that you brought with you, maybe you could give our listeners a detailed overview of Triggers, which may help them in better appreciating the slides that we're going to go through.
Well, from Triggers ourselves, we have a lot that we offer on top of what you give us. The webzine has updates 4 times a week. Right now, we're working on a methodology that allows us to pinpoint high probability targets, and that's what the charts are going to be going through today to discuss. And you can find that in our updates as we go through. And it's kind of a proof of concept as we publish these things 4 days a week with the high probability targets. Either they hit or they don't. And that kind of proves our concept for us. And we're finding, like I said, all this summer, we've had great success with what they're doing so far. So the charts I want to show this presentation are going to take us through some of those calls this summer and show everybody what's going on. And hopefully they'll like it and be able to come back to Triggers and decide to learn more for themselves on what's going on.
Andrew, I need to just take care of some mechanics before you take us through those slides. I'd ask our listeners to open the slides to full screen viewing. You need to open the slides to full screen viewing to properly see the detail we'll be showing you. There is an icon in the bottom right corner that by clicking it, it will do that. It'll explode the screen in size. The slides will automatically advance as we go along. There's a box below the slides where you can make comments or ask questions. Hopefully, when we have Andrew back, we can answer some of those questions. I also need to be very clear that the slides this morning are for educational and discussion purposes only. They are not to be used for trading, nor are they in any way investment advice. They are solely for discussion purposes. Andrew, would you like to take us through the slides that you brought?
Yes, Gordon. If we take a look at our first chart, it's actually from July 24th. And you'll notice the highlighted areas, the yellow highlighted areas that I have marked up. And these are our targets, or what we're calling high probability target zones, and they're derived from our trading methodology that we're using. Trading methodology is a purely technical system, and the following charts that we're looking at should give everyone an example of how it's working out. As you can see on this chart, we were looking for a move down, probably to the channel. And what we were actually highlighting here is more of the overall move of the wave. So you can see a 3 count at the very beginning from the move up to start this overall wave. And then you could see another 5. And so we were looking for a following 3, and this actually morphs later on. But it really doesn't matter as long as we can get the fact that it's going to be coming in and bouncing at some point and returning up, because that's what we want to trade. So if we go to the next chart on the 26th, this is a couple trading days later, and our target at R was just about reached. The timing was saying we were due for a lift, and the divergence at the bottom you can see on the indicator was also adding support to this forecast that would be where the bottom was met.
I know you use a broad range of oscillators. And you just try and take some highlights to really show where there's major divergences rather than cluttering the charts with a lot of the oscillator studies you use?
Yeah, the methodology that we're promoting right now actually only uses the one oscillator. That doesn't mean you can't use more. We're trying to keep things as simple as possible. I use the Williams percentage R on these because I find that it works well, but the RSI or the Williams or MACD or something else that the trader is more familiar with, is just as fine. The point is trying to hit the extremes and look for divergence. And that's where you really want to know what's going on. When you hit an extreme, then it starts to tell you that there's going to be a shift or a change coming soon. And this is just one of the clues and indicators that our methodology uses, because there are several other. And it's when these all culminate together that it gives you a clue that this is where the turning point's going to be.
So this is part of this summer, you standardizing and really fine-tuning your methodology. And you've actually decided to really use Williams in a lot stronger fashion.
Yeah, it's not that it's the Williams specific. It's just that I'm using it to be consistent. Any trader could use any other indicator, primarily because you're looking again for the extremes on either end and then divergence. And pretty much all indicators will give you that in one shape or another.
Actually, I really agree with you there, Andrew, because the Williams really identifies extremes better than the others I've found.
I find that too.
Depending on the frequency that you're using, and that is monthly, weekly, daily, hourly. But at this granularity, I would agree that that's what should be used.
Yeah, let's take a look at the next chart. All these charts, by the way, have been published at the date that we're talking. This chart was published on July 31st, and it shows that our bounce did occur, and it lifted up to the next target, which we were forecasting to the top of the channel again. On August 2nd, which is the next chart we released, we were looking for a move down to the X, and that's where we got. Obviously, you can see it coming down, and at the same time, we were forecasting that the bounce from the X would move up to the top again. Z would be the next target, and these again are the high probability target zones that we had identified, and they're mapping out for us the market movements pretty consistently.
You're actually, to be really frank, you're just nailing these things consistently. What's behind you picking your target zones? What kinds of key analysis is in there? Would you mind sharing that with our listeners?
Not at all. If people can actually find a really detailed explanation in our latest issue, I wrote an article on the trading methodology and what we do to hit the high probability target zones, as well as our blog that we have has some write up on this. But for now, I can say that we actually use basics. Technical analysis theories, what you would call channels, moving averages, Bollinger Bands, these type of instruments that are very common, and they do in their own right give a certain probability or a target or an area to look at. And so when you start adding these together, they start to overlap, and where they overlap, it shows you the higher probability targets. It's there's a tad bit more to it than that. There's specific settings that I use for my moving averages. There's specific settings I use for my Bollinger Bands. There's certain ways I'm using these channels, but none of it is really far out there. It's just a methodology that you need to learn and see for yourself. And once you do, these targets become very, very obvious. Elliott wave theory is another that I use, but again, it's not so much to the point where I'm mapping out every single wave and what's going to happen. And I'm actually just using the basic theory of, as you can see in this chart, of 3s and 5s. That's just a common whatever. And we may not be in a correction here, which is what the 3 and 5s are looking at. It could be something else. It really doesn't matter what we label it as long as we can recognize that there's 3s and 5s going on, because once we can see the 3s and 5s, then we can project where the next waves are going to move. We may not have the actual count perfect, and it's irrelevant as long as we can see what the next wave most likely will be.
For those that understand Elliott wave or Elliott wave practitioners, you'll understand the significance of 3 and 5 counts as advancing or pullback consolidation waves, and then how they'll form in various patterns such as rising and wedges or ending diagonals, which is clearly being somewhat signaled here. A way I'd kind of summarize what you're saying is that below the surface, you're using pretty well the full suite of classical analysis, whether it's gone, Elliott wave, any number, moving averages, et cetera, that you put. But what happens is none of them in themselves may be exactly right, but when you put them all together, what they start to really clearly show you is some high probability points, and there may be 2 or 3. And a point I would make leading here, Andrew, and the reason for that, and I found the same thing at a higher level, and the reason for it is because all of the computers today are programmed using some basic forms, whatever the theory is, and whether they're even regression analysis, regression channels, whatever. So when you get all these computers, and as you well know, 70% or higher of the trading volume on any given day is all algo driven. And why they start to work out is you've basically got a good statistical sampling of what all of the theory that they've programmed in here. And each of the companies have chosen different parameters, but they generally start like a magnet and collect right to a single point or a combination of points. Do you agree with what I just said?
Yes, 100%. And one of the things I want to make clear too is exactly that what this does is increase probabilities and technical analysis in and of itself. There is no guarantee that you don't know. You're basing all your future moves based on past, so you can't know for certain. But when you start using all the different methodologies and they start overlapping, the probabilities start to increase that this is where the market is headed. And a lot of the times you don't know if it's going to go up or if it's going to go down. And we very frequently will give both high probability targets that if the market does move up, this is where it's going to go. And if it decides to move down, this is where it's going to go. I mean, we have a bias and we have a general feeling that we believe and we think it's going to move in one direction. However, there's market surprises all the time, and you need to trade what the market actually does, not what you think it's going to do. And by using technical triggers to do that, when you set up your high probability targets, you end up using all the tools set up technical triggers for you to use to get to that target. So whenever trigger is hit, whether it be up or be down, then the next target, whether it's up or down that we've high probability found, then that's where the market's going to move to. And this is what's happening is, as I'm demonstrating right now, this is, as I said, this is all proof of concept, are publishing these things. We've been doing this for months and showing that it is working, and we're going to continue to do so.
What you're not mentioning here is what needs to be overlaid onto this is a trading strategy.
Yeah, that's the other half.
And the trading strategy is something that you're not advising on. And I say that to our listeners. A trading strategy is then how you overlay risk and your lot size and hedges and how you protect against risk, knowing what the probabilities are. And and everybody would have their own trading strategy on that.
Exactly. And one of the interesting things that's part of this methodology is that you don't just get one technical trigger for the high probability target. There will be a series. You'll have a moving average, you'll have a trend line or a channel, and then there'll be a Fibonacci level, and there'll be a Bollinger Band. You have all these certain technical analysis tools between where you are and where you believe the target's going to be. And as you hit each one of these targets, each one of these triggers, the probability increases and your risk decreases. And then you need to decide as a trader which one of these you want to use and how you're going to use them and at what risk level is right for you. Because when you look at the market, you can see, yes, I'm going to cross the moving average, but gee, there's a channel right above it. Do I want to risk that or do I want to wait for the channel? And if you wait for the channel, that's fine, but you're decreasing your profit too. So it's whatever your style and whatever you do as a trader and what your risk management is and what you can do and cope with and sleep at night is for yourself to how you're going to trade this. But the methodology itself to get to that is solid.
I don't think anybody's offering one to the public right now as a platform framework to build from and to get other input into.
Once you understand what I'm doing here, if there's other tools that the trader himself already is aware of, that technical analysis that they're already doing that I'm not doing, they can easily add that into this methodology and increase the probability and these high probability targets even that much more.
Exactly.
And again, we're using the basics of all of the tools that we have, using channels, using Bollinger Bands, moving averages. These are not difficult things. Even when we get into the Elliott wave, it's just the basic concept. And same with GON, just understanding the price and time square and the different levels. These things are very, very easy to understand and apply. And that's part of the point of all of this is all of these systems are very, very simple. And the methodology follows a KISS or keep it simple strategy so that when you're doing this, you don't have to spend hours trying to figure out in technical analysis. You can just put it up and look at it and very quickly focus on your trading strategy because you know what's going on with the methodology.
Well said, Andrew. I do need to make a point that all of the classic trading technical analysis you mentioned, you also use unique settings for them all.
Exactly, yeah.
And that's taken you literally years to decide on what those settings are.
Yeah, we're going over 15 years of market study and figuring out what's better and what's not working and even going through automated trading platforms and trying to set up programming strategies and seeing through those what does and doesn't work. All of this has kind of culminated into these settings that, for whatever reason, they seem to be working well. As I'm demonstrating it, they work. I don't know what else to say about it.
Well, and I know you and I worked for a number of years on some of them.
Yeah.
And some of them we came up theoretically, and some of them we just simply stumbled over.
Exactly. Yeah.
By watching all the time, and so they work. And people could cut down a lot of time and a lot of years just by using your framework. Do you want to go to the next chart?
Yeah, well, let's just again, I'll comment that chart we were looking at was released on August 2nd, and we were moving to the X, and then a bounce to the Z was what we're looking for. And if you notice, the green highlighted box area is exactly the same size as the 3 count move up, and that's kind of what this is highlighting. And one of the reasons that the Z is a target, we were looking for this whole move to be the same height as the very first 3 count was. And if we go to the next chart, a little bit forward in time, and this is on August 14th now, and we can see that the market has moved up, and it still actually hasn't come to the height of the blue box that we were just talking about. In other words, that this current wave that has now moved, as you can see, is morphed into a 5 count, is not reached its height yet, even though it's gone further in time. So we're still expecting actually that to lift and reach that point. There is alternatives that, as we were discussing earlier in the methodologies, you can see points on the charts Y and F, and these were given should the bounce at X not happen, or the pullback at PT there, the supports didn't hold. Were that to fail, then the F would have been the next target, most likely high probability. And between those, you would know as soon as those things start failing. You can see that on the chart, and there's lots of opportunity to get in and out, however you choose.
Andrew, do you want to make a comment on why you used the 2 boxes that you're showing?
Yeah, it's just a really simple strategy to highlight the very first 3 count wave that we had there. And what I was looking for was to keep in context where this other, it's not only does it the height, but it also shows us the time it took. So you're looking at a lot of information in just a simple box there. And when you transfer it over, you expect, we were looking to compare it to, and you can see where the first count, how high it went and the time it took in the current wave. And as it's showing, we haven't quite reached the height, but we've taken more time.
Yeah, what you're trapping is price and time.
Exactly.
By using a image or a mirror image here from a measurement. Another way of looking at it is you're trapping energy or you're trapping momentum. And so the energy is dissipated or will change in form, but what's the old law? And in physics, energy can either be can be moved or it can be transported, but never destroyed. So in fact, what's happening is the energy shifts. By using the boxes, you can trap where or come up with a projection. I'm being a little complex here, but these are not just nice little boxes that you stick on a chart and say, oh, don't they look right? There's a reason why they're in there.
For sure.
And think momentum and energy, and they're a function of price and time.
And you'll notice inside the blue box, we have a little green box there, and that little green box is showing the very first part of that 3 count. And if you transfer it over and you look at what we've done, the very first count actually conformed. In the green boxes, they're very similar. And then the next move of 2 starts to the X is very similar to what happens in the beginning of the 3 count as well. And then from there, it actually starts to change and shift.
This is the whole basis of fractal theory and chaos theory. And the markets, in fact, always paint fractals. But a fractal doesn't necessarily mean it's a complete mirror image. The fractals have a very similar pattern, but the patterns will be distorted. And so you have to know how they're going to be distorted and how to spot fractals. And this is all part of chaos theory. And frankly, it does even Mandelbrot, who came up with Mandelbrot theory, he believed there was Mandelbrot generators that would, in fact, model the market and isolate these fractals. He spent years working in the cotton industry trading, trying to figure out how to reproduce it, but he never did, though he is clearly the genius behind all of chaos theory, which is a cornerstone of quantum physics and new sciences today. Didn't mean to get us off track, Andrew, but I just want to make sure that some of our listeners really understand the level of science that's going on here. These are not just pretty charts.
Sure. The next chart is a couple days later on August 16th. We are slowly making our way to target M. And this is the top of we've now changed those boxes into a triangle. You can see the triangle has come from the previous move up and gives us some goals to consider. At the very least, we're looking for a target at M, and this is what we were talking about, the same height. I moved to a triangle for various reasons, but one of them is primarily I was just now focused on the height, the blue bar at the top, and I wanted to keep the representation of where that was coming from the first move. And if we move on to the next chart, we see that the market actually continued its lift and did reach our target of M. And also on the right, we introduced target S's to where that pullback after we hit M is going to come.
You can see down in the Williams number, it's been at the peak and hovering here for a bit of period of time, broke a trend line. So it's setting itself up for minimally some level of retracement.
And on the next chart, this is from August 23rd.
And there it is.
And we shows that the M is finally hit for sure. And we've also now that that's hit, highlighted S's to the pullback area that we're looking for. You'll note that we appear to have targets in both above and below the market again. Well, we have a bias on the trend and the target we are looking for. We also understand that we are not infallible, and the markets can be full of surprises. Our methodology uses the technical triggers for consideration of entries and exits, and we give the high probability targets above and below the market, as well as the technical triggers for either direction. When the market does make its move, we follow the technical triggers and get out, as they say, or in. So while we have an expectation and a bias as to what we think the market may do, our methodology trades what it actually does. And if we look, I think today, as we're talking about this, Gord, we are almost now down to S.
Yeah, we're recording, for our listeners, though this is on Tuesday, we're recording this on Thursday afternoon before the long weekend, just because of timing and travel. And as of this morning, the market has just plummeted down towards your S. And you published these. This chart was published yesterday to our pre-market.
Well, this chart was on August 23rd.
I apologize. Yes, that's right, because it's not updated here. Because we had a little bit of a down, and then we had an up.
Yeah. So this last week's chart actually is what I was expecting, and this week that's actually what has happened. This week has moved towards S, and today we're actually getting a dump down on it.
Which just really proves how well the methodology. You know, Andrew, I like the fact that one is showing an upside and one's showing a downside, with the downside being the bias. And I say that because of what's happening in the market. The market is so focused now on what the ECB will do. And this is where our macro overlays into our charts. And from a macro standpoint, what's going on with the ECB, what Draghi is doing right now, what he's signaling with the Bundesbank. At the same time, what's happening at Jackson Hole with the monetary conference of the leading monitors around the world. The market is just in a frenzy of whether we're going to get some level of short-end buying on the ECB here in the next few days, or whether Bernanke is going to trigger some level of QE3 or another form of it. So the market is set. That's why it's set up. If they do it, we'll get in. If they don't do it, or if there's some other kinds of feelings that it may drag out a little bit, we'll get S. And I think what's happened this morning is we're starting to see the concerns that Draghi's got a fight on his hands with the Bundesbank. They're not going along with it, and it's going to delay it. We'll get there. And in fact, there was no signal out of Bernanke at Jackson Hole, and therein lies what the charts are really telling you. And so part of this is to sit down and decide what you think the risk is and how you'll trade that risk. There's strategies that you can use to do that. They're called straddles. There's various options for those that are more sophisticated to be able to play the fact that you can make a lot of money, Andrew, just knowing it'll be an N or an S, not knowing which one.
Yeah, exactly. And
I'm not advising that. But I'm just trying to say that there are a large number of players that is how they execute their trading strategy.
For sure. Part of the methodology, the point is to trade a purely technical system. And the point of that is to get rid of all of our bias, all of what we think may or may not happen, for the simple reason that we can be wrong. So this is increasing your probability of getting it right, because you're just trading what actually happens. And while we do have a bias and we do think the market's going to move down, I've been wrong many times, and I'm sure I will be in the future. However, if I trade the technical triggers and not what I actually think, I mean, it's good to have a map of up and down as to where things are going to be. But until the market actually makes its move and starts moving through the triggers, you don't know for sure 100% which one it's going to be. You never can know. It's impossible. It's the markets. But if you use the technical triggers, you can get in on the right side in the right direction. And that's the point of the methodology and why we give the up and the down as we do.
Great discussion here this morning, Andrew. I really appreciate the time and going through this. We're up against our hard line. Going to have to break here. Any closing comments you'd like to make? And could you tell our listeners how they could learn more about what you're doing, how to get a hold of you, and any other information?
Sure. Our website is triggers.ca. We actually have a new blog that you can get to as well. The site has a whole bunch of free information, and from the site you can get to our blog by clicking on the more information with respect to methodology and strategy and trading. And you'll see it when you get there. And the blog itself, we're posting some updates like you're seeing now, some charts of what's going on just for the SPX. But we do this type of analysis in our updates across many different markets. You're just seeing an example of our methodology on the SPX. But we also do this for gold. We do this for the US dollar. We do this for currency splits. There's a bunch of different charts that we do this for. So depending on what you're trading or what you're looking at, you can see what we have on all of this stuff. Another reason we do it across market is because I believe that having an awareness of where these high probability targets are on the US dollar and on the SPX and on a euro yen split, for example, understanding where it is in all three, and that all three of these actually move together, which is where you come in with your drivers. Then you can see and understand which one it's going to be. The up and the down becomes actually a lot more identifiable because these three move in tandem to some degree.
For our new listeners, when we say drivers, we're talking the macro drivers. So a lot of my work identifies shifts that are happening between the crosses, for example, in currencies, the yen, euro, US dollar. It'll identify, for example, what yields are shifting and the spreads that we're seeing and what we're anticipating. And when you take that analysis, that fundamental kind of work, overlay it onto the charts, you clearly see the charts in a different way. And then when you overlay multiple markets, currency markets, yield markets, equity markets, etc., you start to see common points, high probability points. And then as Andrew takes it down a whole other level with his work, with all of this in mind, clearly in mind, at various chart levels, monthly, weekly, daily.
Hourly as well.
I apologize, exactly, hourly. What happens is you're reducing the risk. You're getting a high probability that these are strong targets, not guaranteed, but high probability, to base a risk-based trading strategy on.
Yeah, all of our charts, as you can see, we've just shown you the highlight of the actual chart itself, but these are pulled right from an updates that we have published. And along with the updates, we also give the target locations, what the triggers are, and the drivers for the market. And for each chart that we put out, not just the chart you're looking at.
We have to run, Andrew, and we'll be back next month. I'm looking forward to continuing it and seeing how well methodology continues to prove out. Have a good summer.
You too.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.